Hi, James. Hopefully you're not going to feel too grumpy after speaking to me.
No, I have to say too. Oh, hang on. Sorry, I've just flicked straight through the slides. There we go. So we're talking about Baillie Gifford UK growth. Here's your new investment objective and policy, which is a bit wordy. So I thought we'd just stick that up and then skip straight past it and talk to this slide, which is the investment philosophy. So I think probably people are quite well versed in this, but maybe it's worth you just reiterating it for us, please.
Sure, James. I mean, I think you met, or you spoke to one of my co-manager, Milena Mileva, just over a year ago. And yeah. I think the kind of point I would say to the audience is there's been no change. And I think hopefully if you ever invite us back, if you're feeling more or less grumpy about us, you'll hear the same story, because this is something we've been doing for a long time for institutional clients, and it's basically more recent from a retail side. But we're active, we're patient, and we're growth investors. And knowing Baillie Gifford, none of that is going to surprise you in some respects. But from a UK perspective, we're trying to find, between currently about 45 of the best ideas we can find in the UK. High active share, about 85%, which I think is, as you know, James, is quite high for a UK fund, given the kind of concentration of the market. But it's best ideas. And in terms of how we think about investing, we are trying to think in decades, not quarters. And I think the best way to illustrate that is our portfolio turnover, which you can see there is very low. So I think if James, you asked me about all the new exciting things that we're doing. Well, actually, yeah, we are finding actually one or two interesting ideas, but it's very, in the context of the portfolio, it's not big. And I think that's really important. What we own is far more important than all the new flashy, new shiny new things perhaps you're talking about earlier. And the reason for that is that we spend a lot of time thinking about companies, and I don't want to go through all our process, but there's a lot of thought going into it, because we are potentially making an investment for up to 10 years. So you can imagine we are spending a lot of time thinking about it. But ultimately, it's about letting the power of compounding work for you as a client. Because if your portfolio turnover is higher, in our view, is you are trying to kind of time the market, and you're kind of chopping and changing all the time. And we're not smart enough for that. We just think, our value to our clients, I think, is finding great companies and trying to own them for as long as you can, because we think in the long run, share prices, follow fundamentals. That's that growth point on the right-hand side. And really what we're trying to do is to find companies that have that superior growth over the long term. And in the short term, that means that share prices can go anywhere, and our performance might be volatile. But we're not going to react to that, because what we think is really important is that long-term growth. So I don't know if that's helpful for a starter, James.
Yeah, definitely. Thank you. This is talking about how you actually go about choosing stocks. I think this is interesting from the point of view of what makes a good company from your point of view. And it's interesting that you've got sustainability in the middle of that too. Do you want to talk a bit about that?
Yeah, I mean, it's, if it can be kind of am I right to be controversial?
Of course.
Good. Oh, good. Well, I mean, look, I know everyone is talking about ESG at the moment. It's the three kind of letters of the du jour, and I'm in a way, I'm a bit worried that this very important topic is getting hijacked by box ticking, and it's all about risk. When actually the way we think about it, because we're long term, I think we've always thought about these issues, because if you take, for example, if you look at the average portfolio turnover in the UK, it's people hold a stock for a year. So if you only hold for a stock for a year, why should you care about these long-term issues? You shouldn't, because it doesn't have any impact on you. But if you're potentially going to invest in a company for 10 years, these things are really important. So that's why, James, that question is in our framework, because we are trying to understand what are the potential risks there, but crucially, what are the opportunities? And that, I think, is something that a lot of people miss out on. And if you listen to all the COP stuff, in Glasgow, it's all about doom and gloom, and it all sounds very depressing. But actually, what we think is that, yes, there are definite challenges. I'm not trying to be a Pollyanna here on a Friday morning, but actually, there are actually good things happening too. And the great thing I think about capitalism is that you find companies and they can allocate capital to people who are finding solutions to problems. And I think that's something that, in the long run, and again, it sounds very hard from a Scottish person, James, is saying this, you should be optimistic, because in the long run, if you've bet against optimism, you've generally lost out, I think. So that's why it's one of our kind of key questions in our framework. But I'm not going to go over it, because I'm sure you have lots of fund managers of all very pretty charts here. But I think the point of what we would say here is that we discuss this as a team. There's about a team of 7 of us working on this. A very experienced team. And we think about this. So you're getting the benefit not just of myself and Milena, but also our colleagues who are feeding into this, and we discuss everything as a team. And I think that's a really kind of key thing, because our culture at Baillie Gifford is about teamwork, and we discuss everything together. And then there's clear accountability, for example, for the trust, where it's myself and Milena that are running that fund.
Just to go harking back to what I was talking about earlier, is there enough to do in the UK, or would you like to have some more global stocks sometimes?
Oh, look, we get asked that a lot, and I think it's a myth that you can't find growth businesses in the UK. I know I've got some certain colleagues in Baillie Gifford who have been very vocal publicly about this point, but I think the fact is that's fine if you're only looking at the well-known names, that dominate at the top of the FTSE 100. But with the greatest of respect, that's kind of not, that you're not getting into the grass and finding the really interesting companies, which that's what we spend our time doing. So I'm sure, our portfolio looks very different from the index. And that's really important for us, that, the fact that, we find a lot of the index is of no interest to us. So, for example, we don't own banks, we don't own oil companies. We never have since we took over the trust. That can cause short-term volatility in the share price. I'm sure we'll come back to that point, or in terms of performance. But does that make me want to change my mind on those long-term points? Because we think on the long term, both of those industries, for example, are in danger of disruption. So what we're trying to do is to find companies, I suppose bluntly, are on the right side of history. And not all of them are going to pan out. Let me make that clear. But I think that's the great thing about growth investing, is if you can find businesses that can potentially, find new markets, you have unlimited upside. Whereas, bluntly, the worst you can do if you make a bad investment, you lose 100% of your money. But you can make multiples of your money if you get that right. So, I mean, I can give you just, I can ramble on and on and on, James. But I mean, to give you an example, recently in the portfolio, we've bought 2 or 3 new holdings, which is for us is quite exciting by our standards. We bought Wise, the foreign exchange provider. We bought Oxford Nanopore, and which you may have heard of. But there's one I'm pretty sure you haven't heard of, is a company called Existentia, which don't ask me to spell it. It's too early in the morning for that. But it's a business. It's a British business, but it's actually it's quoted in the US. It just IPO'd quite recently. But what is interesting about that business, and what I'm referencing, is it uses AI to help traditional drug companies be more efficient in their drug pipelines. Because I think, as we know, and I'm sure you've probably had these agonized discussions in the past about things like GlaxoSmithKline and things like that. Why can't they they spend billions, but they don't seem to find any new drugs? Well, what this company does is it uses AI to help them be more streamlined and more efficient in that. And there's been early tests and certain individual drugs with certain pharmaceutical companies where they've been 70% more efficient than historically has been the case, to get to that point of when they can start to put it into trials. So that's kind of really interesting. And the fact that their partners are kind of well-established companies like Bristol Myers Squibb, Bayer, Sanofi, the Gates Foundation. This is an interesting. This is a company that nobody's never heard of it, but actually it's a British company that could be world class in this area. And it was interesting that we have a global healthcare team. They helped us with our research, and they came to the same conclusion that this is a world leading business. So that's a kind of business that it's small. It's a starter position. It's higher risk, obviously, but I think the market that they are serving, they're trying to solve, as I said earlier, a big problem, and that's quite exciting to us.
Yeah. Stewardship is just a given, I suppose. But how involved do you get with company management, and how sort of close do you end up being with them?
Yeah, well, again, at the danger of sounding controversial, I don't think it is a given. A lot of people talk about it, but not everyone does it, or certainly what the reality is and the rhetoric are not always the same thing, if that makes sense. And what we've always tried to do in the UK team in Baillie Gifford is we take a very joined up approach. So, we have an ESG specialist who works with us. It works exclusively for us. And we work together hand in glove. So what I've seen elsewhere, and I've been told this from some of these other bodies, that the ESG people don't speak to the fund managers, or vice versa. Whereas for us, we're speaking all the time. But crucially, when we make a decision on something, or when we're engaging with something, we talk as one. And again, I find it quite amazing. But again, in a lot of organisations, that's not the case. That the company can then try and pressurise the fund manager to kind of change their mind, and they do, which I find really, really quite bizarre. But apparently that happens. Whereas for us, if we're engaging, we engage often together. And my experience is that if you're put in front of a chairman with a fund manager as well as an ESG specialist, you get taken quite seriously, because frankly, you've got a decision maker there as well as an ESG person. That's not, Anne, our ESG expert, is really good, but there's no getting about the fact that there's a portfolio manager there too, pressurizing, potentially a company on something. It can be important. Now, when you're saying about how do we engage with management, or how often, I think it depends, James. I mean, a lot of companies, hopefully we're trying to pick above average companies. So hopefully companies not with huge number of problems. Our job is not to try and sort them out. But reality will be that sometimes a company does have a problem, and then you have to get involved. And there's a couple we've talked about in our reports, Rio Tinto and Boohoo, where there have been issues, and we have had to engage. Blaine and I have been quite active in both of those alongside our ESG experts. But the interesting thing there is it becomes quite intensive. And for example, the Rio Tinto, you recall they unfortunately they blew up some sacred Aboriginal caves, and I think we had about a dozen meetings with board members, executives, some kind of industry experts over a 12-month period to try to get to the bottom of what was going on here, and also to try and have a constructive challenge about that. Now, one thing I would say, James, is that none of that went into the press, because we sort of think, again, being a long-term investor, that the best conversations you can have with management is one where there's trust on both sides, that allows you to speak frankly to one another. And hopefully, in our perspective, we're willing to listen to what the company have to say. And I think that's really important. And I don't think our industry has always covered itself in glory by people effectively leaking stuff to the press very quickly. And, it doesn't help a conversation. You can imagine if you and I were sort of having a very private conversation, and then, it kind of, you read the Times next day and it's all splashed over it. It doesn't engender trust. And I think actually, if you have trust, it allows sometimes a pretty frank conversation to be had. And I think, I don't want to kind of break the confidence in that respect, but what I'd say in both those cases was that, both Milane and I had some pretty frank conversations with both of those companies about some of the failings. And, we think that's the right thing to do, but we're not going to kind of boast about it afterwards, because I think, again, it's a long-term relationship with these companies. It's not just about, well, great, it's almost like I've bagged a kind of scalp here and we can move on. You've got to keep speaking to these people. And I think my experience over time is that people respect the fact that you can have that conversation. Sometimes it's a tricky conversation, but if you kind of manage it professionally, and they will respect you more. And I think that builds a relationship with companies, I think is really important, going back to stewardship. Sorry, it's a long-winded answer there.
No, I think it's good. That's helpful, definitely. How much research are you two doing yourselves?
Well, I mean, the thing about Baillie Gifford is that the fund managers do research as well as our analysts. So that's our kind of style. I mean, I think our challenge, I suppose, like everyone, all portfolio managers, do you have enough time to spend on it as you would like? But I think, again, going back to this point about, low portfolio turnover, we spend a lot of time just thinking about our existing holdings, meeting them, challenging them, perhaps meeting competitors, or, trying to understand what's going on in the industry. So there's a lot of stuff that is almost tangential, but are actually still very central to understanding, does this company still have potential to be above average growth over the long term? And you can see there on the slide, that you can see our kind of top 10 holdings, which I think would be pretty familiar to if you'd looked at it over a year ago when Milena was speaking to you.
How important are brands to make a company like a decent company? Is brand strength something that you value?
That's a really interesting question. I suppose the question is, what do we mean by a brand? I think probably most of us would, in the audience, would all probably think of it. You think of a consumer brand, a Coca-Cola or a Kellogg's or something like that. But if you look at our portfolio and even looking at the top 10 there are a lot of what I call brands, but they're probably more business to business. A good example of that is Howden Joinery. Howden's, which is the kitchen manufacturer, and they only sell to the trade. So if you and I sort of popped over to our local Howden, we couldn't buy anything there. We'd have to get a builder to do that for you. But in the business, in the building trade, they are very well known. They're the number one player in that market. And why do people like it? It's not just the brand. It's the fact that they have the widest choice and they have it in stock because they manufacture a lot of it themselves. Now, the thing that, going back to kind of engagement with companies is, we've spent a lot of time the last few years, encouraging them to kind of keep investing long term. So in one sense that they've had, if you're short term, you've probably been a little bit disappointed at times because they kept saying, look, we're increasing our manufacturing presence in the UK, we're adding more things, and that have a short term impact because, we're investing and that has a depreciation charge, et cetera, et cetera. But then you kind of go to, today, when people are now fretting about supply chains and supply chain security and so on, and in comparison to some other, kitchen companies that you're having to, which traditionally still import a lot of their kit from, abroad or China, and are having problems, Howdens are actually in a very strong position because they manufacture their stuff themselves, and therefore their competitive position improves. And I think that's a kind of, if you want to say that's a brand, I would say that's how a business really strengthens its brand, because it's not just about, it's a flashy kind of sign or something like that. It's actually, are you delivering value to your customers? And that, I think, is a really important thing. And brand, in a sense, it's an interesting question. There's a lot of companies there that, the man in the street or the woman in the street probably wouldn't have a clue who they are, but actually for who they're selling to, they are very strong in their markets. People know who they are and what they stand for, and that's the type of kind of companies we really like. I'd probably accept, I'm looking at it there, would be something like AutoTrader, which everyone knows about, and that's an interesting one actually, because it's one of the few businesses I can think of where it actually helps both the retailer, the second-hand car retailer, and the punter. So both kind of sides of that actually value the AutoTrader website, because actually it's useful for both of them. One for, James, if you want to buy a flashy second-hand car, that you can find it on AutoTrader, but equally for the car retailer who wants to kind of turn their stock, which is one of the big killers for them, if they can't do that, AutoTrader helps them to potentially widen the market that they wouldn't have seen before. Because let's say, James, you wanted to come up, you would never think of coming up to Edinburgh to kind of look for a second-hand car, but actually, if that's the kind of your dream cars is up here, you'd probably make your effort to do that. And it's that type of thing that where kind of these platforms actually help both parties.
Yeah. Okay. Thank you. It's an interesting take actually on that. Somebody's just asked, why is Genus the largest holding? What's the story behind that, please?
Yeah, I mean, Genus is a very special business, and it happens to be a British business. It's basically the number one player in the world in terms of pig breeding and beef breeding, and what's happening in agriculture is that, as you know, particularly in emerging markets, but even in Western markets, people are, as they get wealthier, they want to eat better quality. And what Genus does is allow the farmers, and it could be like an industrial farmers to be. It's not just like a Farmer Giles. It's it's really kind of quite big kind of concerned to allow them to be more efficient and better quality, and understand how they can improve their herds, because that's the kind of key things. And what is interesting about it is, if you take China, for example, that in China they consume a lot of pork, and as they're getting wealthier, and they're getting wealthier every day, they want to consume more. Now, that market traditionally was the equivalent of a couple of pigs in the backyard for a lot of people, and it was really, that's why you've had, I'm sure you may have read about it, occasionally they have these outbreaks of disease and the kind of wipes out big chunks of the Chinese kind of pig market. But what's happening, and again, this is the sort of thing, is that the Chinese government has said, look, this doesn't make sense. We need to industrialize, because we know in the long run that we have to, we're going to be eating more pork, and we have to be more organized. And we need to kind of understand that. Genus is now kind of partnered with a business in China to help address that market. So not only is it a business that's kind of got existing markets where it's a very strong position, and it's getting stronger because it's got the kind of financial strength to keep investing. And this is one of the key things, because most of the competitors are generally like farmer cooperatives, and don't have the capital to invest in the same way as Genus. But also the fact that there's some big markets like China that are starting to open up to them, which is exciting. So that's why it's a big holding for us.
Okay, thank you. Now, this slide is a bit old, but since you say you don't turn over the portfolio much, I'm guessing that not much has changed.
Yeah.
But I just thought this is interesting, because it just sort of breaks down different ways of thinking about where the portfolio is positioned.
Yeah, it's obviously carefully designed to sort of make it hard to read, because it's got a lot of stuff on it. But just because it's kind of out of date, James, doesn't mean that it's not good. I think it actually kind of, as you say, it can actually get to the heart of what we're doing. And the reason why we broke the portfolio up like this, because we felt that the traditional way of showing your portfolio, and which we show, just to be clear, doesn't really help index positions. Whereas actually what we think is actually more useful is trying to find where are you investing that money, and what you see here is how we try and break it up. And almost kind of going back to what I said earlier, if you look at the top right hand side of it, and if you can just about squint it, or actually I can hardly read it myself with my glasses, it's saying niche B2B champions. And that's actually kind of going back to what I was saying earlier about we were talking about brands, that these are businesses that the man in the street doesn't know about, but they do have a really strong awareness amongst professionals, and actually they're often really attractive markets that they can continue to grow in, and and there's a variety of different styles of businesses within that, and it's actually an area that actually the UK is really good at. I know kind of people always kind of are trying to do down the UK, but I think that's a business to business is actually an area we've always done really quite well in. And then I suppose probably more controversially, perhaps, is on the bottom left-hand side. I'm sort of waiting for all the hostile questions about, well, why do you own all these dreadful businesses? But again, we do find there's a number of growth financial businesses in the UK. So, we start with a point about, we don't have to own anything. It's where do we find the growth? And platform businesses in the financial area do excite us, but also insurance. Both non-life and life insurance, we can find individual businesses which we think have got really interesting kind of growth potential, and that's kind of why we own those. And then on the top left-hand side, we do have these kind of business to consumer compounders, which it's a smaller part, but it's still a really important part of our portfolio. And then what you can see there is a kind of one or two very strong brands, like Diageo, which is it's got a fabulous collection of drinks businesses, or brands, I should say, but also some really interesting new businesses like Farfetch, which is the the platform. I'm not sure, James, if you use that to kind of for your wardrobe, but this is kind of a luxury goods kind of platform, and it's interesting because what it does is it doesn't own the inventory. It actually puts together the consumer and either the brand or a particular shop. So, for example, and I'll use an example of this. A colleague of mine in the firm was looking for a dress. She couldn't find it in the UK, but she wanted to Farfetch, and she found that for her size, there was one left in the whole of Europe, and it was in one shop in Austria. I think it was in Vienna. Yeah, it was in Vienna, and because it was in Farfetch, she was able to get it. So she got the last one that happened to be in Vienna. Now, unless she happened to be kind of flew over to Vienna and happened to be in that shop, she'd never have found it. She'd have assumed, no, I can't get it. So it's things like that that I think are really quite interesting.
Yeah. And then the last one on there is Rio Tinto. So we've seen like your colleagues at Pacific Horizon have actually put quite a lot into mining companies because they think that they are the picks and shovel people for EVs, electric vehicles and things like that. Is that part of the angle with Rio's, or was there a different kind of thinking behind it?
I don't. I wouldn't over-egg that one. I mean, they do have a decent amount of copper exposure, but which will help on an EV perspective. But I wouldn't say that would be the driver. I mean, I think the real driver for us was they have this phenomenal position in iron ore, which is needed for steel, particularly in China as China continues to grow. And basically, we just felt that the market still was underestimating the very attractive financial characteristics of that business. I mean, as you know, James, this is a business area that historically has been dreadful in terms of capital allocation. That they make lots of money, then they kind of blow it on really bad M&A, usually at the top of the market. Whereas what is interesting this time round is, I think, having been burnt quite badly, people like Rio have been much more disciplined in terms of how they're allocating their capital, and their balance sheets are basically almost bursting with the amount of cash that they have in it. And for once, they don't seem to be kind of blowing it on really stupid things. So that's kind of the reason why we kind of quite like it. It's a kind of a pretty unique business in that respect. And as long as they don't do anything stupid, and obviously, they did something really stupid with the on the Yukon Gorge thing. And so there's always something going wrong. But from our financial characteristics, this business is really pretty well positioned. But there are actually some ESG challenges there, and I should say, because I'm sure you'll say, well, hold on, how is this going to work in a low carbon environment? And that's one of the areas that we are talking to them about is, are you doing enough in this area? Because they are selling to steel companies which kind of emit a lot of carbon, obviously. But what are you trying to do to lower the carbon intensity of the steel industry? And I think the interesting thing is probably in the past, they would have said, well, it's not going to do with me, Gob. That's, you go and speak to the Chinese, please. But actually, people are now saying, no, that's not good enough. You've got to sort of understand. They are part of your supply chain. You are partially responsible for this. You've got to be part of the solution. Don't just pass the buck. And I think actually in the long run, that's a really positive thing. Because I think if we actually are going to deal with some of these environmental challenges, it's not going to be one company or demonizing one part of it. It's actually people working together to help that. And clearly they are making some positive steps in that area. And they have that financial capability to do that, which I think is encouraging.
You mentioned you bought some Wise. Generally, sort of fintech, is that an area you like?
If we think there's a kind of growth potential in that market, I mean, why we like Wise it was interesting. I mean, I should go back a second. We actually knew Wise for a number of years because our private companies team owned it, and I think that's one of the advantages of Baillie Gifford is that our private companies team speak to us, and actually I'd met them before they ever even came to the market, so I knew the business and I knew what they were trying to do. So when they did float on the exchange, we had a kind of pretty good feel for who they are and what they're trying to do, and they'd actually delivered on everything they'd said before. But what I like about that business, James, is the fact that they are providing a better service to customers. So what I mean by that, if you decide, I know, in a bit of optimism that you're going to buy a sort of a second home in Spain, sort of thing after this, and you find that ideal, that dream property for yourself, actually you'll save a lot of money if you put the money through Wise in terms of foreign exchange compared to a bank. And I think this is an area that people don't think about, but actually it's really quite important. Where do banks make their money? Because nowadays, they get hammered on things like fees and overdraft fees and so on. So where do they make their money? It's things like foreign exchange. Because often, in the past, people were captive. In the old days, you'd have said, right, I have to, I don't know, let's say you're a customer of Barclays, I don't know who you are with, but you'd have to go to Barclays and then they just charge you the rate and that'll be it. And you'd probably check it and it kind of look broadly okay, and then you just have to accept it. But the fact is that the banks have been gouging their customers for years in this area. And what Wise are trying to do is say, well, actually, what I'm doing, I'm not, I'm almost the go-between between a buyer and seller. So, for example, if you're trying to buy euros, you've probably got some customer elsewhere who's trying to sell euros. You can across them effectively, and you're only charging a very reasonable fee for that, and you actually save potentially, thousands if you're making quite a big purchase. So that's a kind of, to me, is a really interesting model. But what I really like about them on top of that is that they're reinvesting part of their growth back into lowering fees. So it's not that they're sitting there being very comfortable. It's actually they're trying to kind of grow that market. And if you look at a lot of our American kind of businesses, and we don't own in trust, but our Scottish Mortgage and so on. One of the things we've learned, and this is the great thing with Baillie Gifford, we're always trying to share learning lessons, is that it's businesses that are not just talking about short-term profitability, it's about trying to grow their markets. That's the really key thing. So that's the kind of businesses we like, and the kind of conversation we've been having, even for example about inflation. Pricing power. Is it just necessarily about putting the price increase through? Could you also think about, is this an opportunity to really grab more market share and things like that? And we can talk about that if you want, but that's the type of thing that we're trying to do there.
Oh, thank you. You had a question about private equity, and you mentioned the team. So what's actually in the portfolio at the moment?
Yeah. Nothing at the moment. We actually only got permission to do private company investments about in the late summer, so it's very early for us. So we just kind of got the agreement from shareholders to do that. What I would say is, we've looked at one or two things initially, but we haven't done anything yet. And hopefully, I would reassure people that if anyone here is a shareholder, we said, look, we're not going to dive in here. We'll wait until we find something that we think will really add value to the trust. So we're being patient, we're looking, but we're not diving in because, there's a few things here that our private companies team have done. But the interesting thing is there are some really potentially exciting businesses that historically would have come to the market by now and that haven't. And it's not all doom and gloom in terms of technology in this country. There are some interesting businesses, and even things like, I talked to you earlier about Existentia, that the biotech business it's been a terrible area historically, but that's changing now, I think, and so there are reasons to be optimistic, but just watch this space. I think would be the thing, James. We'll see what happens in a year, but just to be clear, there's not going to be a radical change. We can still find plenty of growth opportunities on the listed markets. But we think this is the beauty of investment trusts, in our view, is that you have that potential opportunity to also look at unlisteds now.
Cool. Okay, thank you. There's some performance numbers. There's a little bit. Where are we? Tell me a look at this. I should have got something a bit longer term so that you can see what was going on. Sorry, more detailed. Just sort of talk us through the past year. So obviously we had that big jump in November for the UK.
Yep.
But UK has been underperforming world indices for a long time before that. Do you feel like the UK market's actually cheap relative to the world still?
I think the short answer, I would say yes. I think I'd kind of add 2 points. If it's okay, James. I mean, the first one is that we don't spend a lot of time thinking about the UK market per se, because again, as I said to you, our portfolio is very different to the market. So therefore, it really has got less relevance to us, if that makes sense, because we are looking at our individual companies. But even within that, it is a bit of a puzzle as to why we still think there's some really good businesses in our portfolio. And if you look at kind of either cross-border comparisons, they still look kind of relatively cheap, although they've had a bit of a bounce recently. But I think that I'm sure everyone's looking at the kind of the 1 year number and saying, well, that doesn't look very clever. What are you guys doing about it? Well, I think two things. One is nothing, because we're not sort of short-term investors, and you can see our portfolio turnover remains very low. And the reason why we haven't done anything there is, well, we're not market timers. That's not what we've been hired to do, and that's not what our expertise. And I think shareholders will be saying, what the heck's going on if you were trying to do that stuff like that. But secondly, and I think probably more importantly, is that we're very comfortable with the shape of the operational performance of our portfolio. So actually, in plain English, I guess, our stocks operationally are performing pretty well. So then the question is, well, why are you underperforming the market? And I think our take on it has been essentially that, always come back to your observation, James, that the UK market had gotten too cheap. It's had a bounce. There's been a sort of almost indiscriminate bounce, and some of the kind of things that we don't particularly like have had a very strong bounce, like oil companies and so on, because of the oil price and so on. So that's kind of hurt us relative performance over a year. But I think we're still of the view that the stocks that we own in the portfolio have got superior growth to the market over the long term, and therefore we'll get these kind of short term kind of bumps along the road, but we're not going to react to that. And if you look at our kind of longer term numbers, you've got a 3 year number, but if you took our institutional product, we've been through these periods before. And what we have to keep doing, and I'm going to say, look, nobody likes to underperform, and nobody likes telling people we've underperformed, but hopefully you can see on our longer term track record that our process and our philosophy, it generally works. So what we've got to do is to stick to what we're doing and to keep at it, but with the added reassurance to you that actually we think the strength of our portfolio is getting better, and therefore that's a kind of potential excitement for the future, if that makes sense.
Yeah, no, definitely. And what's sort of fair time period to judge you on, do you think? I mean, you haven't really quite got 4 years yet, so.
Well, yeah, it's a good question. We said at the outset we should judge it over 5 years, because anything below that is kind of pretty random. So you can say, well, 3 years, you had a good 3 years. Well, so what? That's random. At 5 years it starts to become more interesting. And I say that because actually, I think it said in my blurb at the start, I used to be kind of the chief of investment staff, which is part of the job was to help recruiting people in Baillie Gifford. And as you know, most people in Baillie Gifford investors join us kind of like myself as a kind of graduate trainee. And one of the things the data has always said is it takes at least 10 years to know whether anybody's any good at the job or not. So even 5 years, we're probably cutting corners before you think, well, are Iain and Milena any good at running the trust? But I think we said 10 years. I think you kind of been rolling your eyes at us. So we kind of thought 5 years is a kind of reasonable time frame to look at that. But if you've got your own time frame, that's absolutely fine. But what we would say is, if you want to judge us over a year, don't invest in this trust, because we don't think about it like that. And I hope that sort of, I don't want to be arrogant. I don't hope that's not coming across as arrogant. It's just saying our style means that we'll be out of favour at times, and that's happened over a year, but we're trying not to crow about other times when it works in our favour. And in the short term, these things are random, but hopefully in the long run, the philosophy and the process that we're trying to talk about starts to come through, and you see that in numbers. That's our hope anyway.
Okay, thank you. All right, we've probably got time for another couple of questions, but well, maybe one or two. Let's pick out these. One is, when you do something in private equity, do you ever sort of look at kind of venture type stories, or is it all relatively late stage? What we normally think of as like pre-IPO type investments?
I think generally speaking, it would be more late stage things we've been looking at, but there are one or two interesting disruptive businesses that we've been looking at, that are probably maybe a little bit earlier stage, but why we're really excited about them, they could be really exciting. And just to say that, you know, they have to have a pre-new money valuation of at least 500 million. So we're not really kind of like into, you know, the startup in the back of someone's garage. You know, that's not really what we're looking for. But, you know, I personally would look at a business where we think there's a real opportunity to scale in a way that we can't, you know, that would be really exciting for us. And it's something that we can't find in the public market, which again is an important point. But these things are difficult to find. But, you know, that's but it's always been our case in terms of our philosophy and process that, you know, because our portfolio term is so low, you know, we look at things all the time, but we turn most of them down. So and there's been no difference to that in looking at you know, private or unlisted kind of companies. Same philosophy. You know, it's the discipline of the competition for capital. And I would say that, you know, in our portfolio, we are very happy with the shape of our current portfolio. So something's got to be really good to get into it, if that makes sense.
Yeah, definitely. Okay. Do you ever come at it from the point of view of like themes? So you say like, well, renewable energy, there's got to be money to be made there. Let's go looking for something that is going to exploit the opportunity.
Well, I think if I ever dared say something like that, Milena would probably come and shoot me, because you know, we are bottom up investors. But you know, I think that's a kind of, you know, obviously the truth is always it's more nuanced than that, because essentially when you're looking at a bottom up story, there may be, just take that example, I'm not saying we have anything there, but you know, we'd say, well, we think there's a potential growth area here, and this is why we think it's a growth area. But I think what we're trying to do is to find that individual idea over the, you know, the next 5 to 10 years. You know, we're not trying to say, well, let's say that theme is really exciting, let's pick 5 things and one of them might work and the other 4 don't. That's not our style at all. We're trying to find those winners because we think that's a really important thing here. You know, we're not trying to sort of just play things and hope for the best. That's not our philosophy at all. We want to find an individual company we want to back for a long period of time.
Great. Okay. Thanks very much for that. I think we'll probably stop there if that's all right. So, but thanks for your time this morning. It's really interesting. And as you say, we'll keep following you, and hopefully nothing much will change except that you'll be top of the leaderboard in terms of performance.
Oh, I hope so.
Yeah, cool.
Thank you.
Okay. Sorry if we didn't answer your question today, but I think we had quite a lot to get through. Next week, Jane is going to be talking to David Cornell from India Capital Growth. Obviously, the Indian market's going great guns at the moment, and it's going to be interesting to see what he has to say about the direction of travel from here. And then, in no particular order, we've got Rob Crayford, CQS Natural Resources, and Nicholas Ware, Henderson Diversified Income. We're still not actually sure which way around they're going to be, but I've put them in there, so you're just flagging who we're going to talk to. And then the 10th will be our last show of the year. So we won't do it on the 17th, or obviously not Christmas time. So, and then I'll be back in January with Mr. McCarthew talking about what happened in 2021. So anyway, I shall miss you all next week, but Jamie will be here. So have a good couple of weeks, and I'll see you on the 3rd of December. Thanks, bye-bye.